And ultimately, sure, I can pay bills by selling a stock, but then I'm left with nothing. However, I can pay bills with dividends without touching my principal, without touching my shares, and that's real cash flow that allows me to pay bills. So I love seeing a stock that's going up because I know it forecasts oftentimes more dividends in my future. Hey everyone, this is Ian from ppcian.com. I invest for dividends and cash flow, and today's video is all about that very topic. I received a question from one of you. Thank you so much for the questions. Please keep them coming in the comments below. I will do my best to address all of them, whether it's in a video or whether a written response. Today's video is a response to one of your questions, and the question goes like this. Hey Ian, I bought a stock, it went up 10%. It went up pretty quickly. I bought it for the dividends, but the capital appreciation happened. It happened almost overnight. It went up 10%. What should I do? And the question is, should I sell it, book my gains, lock in those gains, or should I hold it for the long run? So today's video is all about that question. So, as I always do, I've got my notebook. I spent some time thinking about this question, jotting down some notes, and the first thing that I want to talk about is penalizing winners. I don't like to penalize winners. If a stock is doing well, that is a good thing. It means that you selected wisely. You bought a stock wisely. You bought it at a good valuation, and you probably bought a stock that's doing well in the marketplace. The revenues are growing, the earnings are growing. And so if a stock is doing well, typically I take the mind frame of not penalizing. I like to sometimes even double down in that stock. I have a history actually over the years of owning stocks that have gone up several 100%, and rather than sell them too early or sell them at all, I'll double down. I'll buy more shares over time. What else? I love this one. If a stock is going up, oftentimes it is a reflection of great fundamental results. The revenue is up, the earnings are up, therefore the stock is up. Something is happening with their product, something is happening with their strategy. The company is doing well. So again, this goes back to the first point. If a stock is going up, I don't want to penalize the winner. And then if I dig into the numbers and the numbers are good and the stock's going up for good reason, again, I don't want to penalize that company. I want to hold on to that company because 10%, that is great and it's exciting. But again, I have stocks that are up several 100%. By the time I'm done with all of this dividend investing, or not done, but comfortably into my retirement and passive income and financial freedom with this dividend investing, I wouldn't be surprised if I have stocks that are in the 1,000% gain range. I mean, this is going to take some time, but it's very possible. And so 10%, I think that's just a start, and it's a great start. But in my personal situation, when I have stocks that have gone up, I almost always hold on to them. Next point. I love this one. If the revenue is up, if the earnings are up, that means likely the dividend will go up. And this is called dividend growth investing. If I buy a stock today, starting yield is probably going to be in the 3% range. 3% is great, but it's just a starting yield. Eventually, I need my yield over 20%, or even more, 30%, 40%. I'm talking about yield on cost here. The amount of dividends I receive per year as a percentage of my purchase price. And so to get that, I need growth. I need a dividend that goes up over time. And so a stock that's gone up, oftentimes it's up for a reason. The revenue's up, the earnings are up. This is a leading indicator of what's to come with the dividend oftentimes. Company has a history of raising the dividend, and the stock is up, they're going to probably raise the dividend again. So rather than sell and shortchange myself, what I like to do is hold on to positions forever. And I like to look at the capital appreciation. I think it's a nice to have, but I don't look at it as how I'm going to make money. I look at it as a leading indicator of what's to come on the dividend. As the stock's up, revenue's up, earnings are up, the dividend's going to get increased. And ultimately, sure, I can pay bills by selling a stock, but then I'm left with nothing. However, I can pay bills with dividends without touching my principal, without touching my shares, and that's real cash flow that allows me to pay bills. So I love seeing a stock that's going up because I know it forecasts oftentimes more dividends in my future. What else? Sometimes when a stock goes up, it is discouraging if you're averaging in, because the current yield is going down. Stock goes up, current yield goes down. That being said, I don't like to get too tied up in the current yield. Current yield is just a starting point. Again, this is called dividend growth investing. Companies that grow the dividend over time, that current yield becomes insignificant. When you compound rate of growth, a dividend maybe somewhere between 5 and 7% per year over the long term, starting yield is insignificant. And so sometimes it's a little discouraging. Stock's gone up, I got a position, should I just book it and move on? Or should I hold it or maybe even add into it? I have many cases in my personal portfolio where the stock's gone up, current yield goes down, and I still buy in even though the yield is lower than where I initially bought, because I know stock's gone up, I made the right decision, it's a good company, but also that current yield just doesn't matter. It's really about the long-term yield through dividend growth. I want that yield to go up. I want dividend increases year after year after year. What else? So I'm going to take a contrarian perspective here for a minute. You've probably heard of this strategy called the dogs of the Dow. The dogs of the Dow basically means that each new year you look at the companies in the Dow Jones Industrial Average that have done the worst, and oftentimes those companies do the best the next year. So I like to look at this two ways. One, when I'm buying new positions, net new positions, sometimes I will try to buy a company that's a little bit out of favor, but has huge long-term opportunity. It's just been incorrectly priced by the market. I like to do the same when I have a portfolio of stocks and I'm selectively reinvesting dividends. I've got some dividends, they've accumulated, I want to reinvest them in one of them. Sometimes I'll pick the one that's maybe the dog of the Dow or the dog of my portfolio, because I know that if the share price is down, the current yield is higher, it's a little better entry point for my dividends. That being said, once I buy something, unless there's a huge fundamental change in their business, I hold it forever, because I know that the most important thing in my investing strategy is compound interest and time, and I'm in this for 30 plus years here or more. And so if I trade, I take something that's up a little bit, I sell it, then I try to put it in the thing that's a dog of the Dow, try to get something a little cheaper. I could do that, but the fact of the matter is I think it shortchanges my long-term results. I think, one, I'm penalizing winners, which is not always a good idea, oftentimes a bad idea in my opinion, but two, I am creating just trades. I'm trading in and out of stuff, and that is just not my strategy. My strategy is more of a boring one. It is buy and hold forever. Don't care about that capital appreciation, care about the dividends. And I know for maximizing my cash flow and my dividends, it's more important just to buy and hold and to let it grow than to sell and buy other stuff and trade around. So I know trading works for some people, but for my personal strategy, and I've tried trading, I've tried it all over the years, the strategy that I've settled on has been dividend growth investing. So how I like to think about this is everything I've said about sticking with winners, but when it comes to taking advantage of losers or taking advantage of stocks that are unfairly priced, I typically do that two ways. I do it when I'm making net new investments, and I do it when I'm selectively reinvesting dividends. But I will not sell a stock to transition it into something that appears to be more of a value in the marketplace, just because it is not part of my strategy, and it's not tax efficient as well. Another point worth mentioning as well. So just hitting on that last point a little bit more, one of the reasons I love dividend growth investing so much is it's a tax efficient vehicle. You buy and hold forever, you're not taking these huge capital gains. When you sell a stock that's gone up a lot and you're booking capital gains, short-term or long-term, that can create taxes, taxable events, or not can, it does create a taxable event here in the United States. Dividend income, by contrast, can be much more tax efficient, much more tax efficient, because there's a more favorable tax rate, and you're not booking those big capital appreciations. You're just letting the capital grow over the long term, so your compounding effect can really work well and be tax efficient. So anyways, Just a few thoughts here today on this particular situation. I think everyone is going to make their own decision in this type of situation, but speaking from my personal experience over 20 years investing, making a lot of mistakes along the way, making a lot of great decisions as well, settling on dividend growth investing, I've always found that doubling down on winners works for me, holding on to the winners, holding on for the long term, and then selectively reinvesting dividends and buying net new positions when there appear to be other values out there in the market. As a friendly disclaimer, this is PPC Ian, Ian Lopuck, ppcian.com. This is not investment advice. I am not a licensed investment advisor. This video is just for your fun and entertainment. If you are going to go out there and invest, please do seek a licensed financial advisor. And also please note that today's video is not tax advice and I'm not a tax advisor either. I really appreciate these questions. If you are sending in these questions, thank you so much. Please keep them coming. If you're able to like my channel and subscribe, I've been seeing my subscription count go up recently. I greatly appreciate it. I invite you to please do that. The more subscribers, the more likes I get, the more time I have to put in this channel. And I set a personal goal of myself, even at 1,000 subscribers, which hopefully I'll close in on one of these days soon, to invest in some more better equipment so that these videos are even more clear, more helpful for all of you out there. Thank you so much for watching. I will see you in the next dividend investing video.